You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have ASOS, RELX, British Land, London Stock Exchange Group, Reckitt, and ABF. We don't have a US company of the week. Sam, shall I kick us off with ASOS?
Yes. Have things improved since their trading statement?
They're having a very difficult time. So ASOS, for anyone who doesn't know, it's what was a large fast fashion retailer along with Boohoo. They've had a very difficult few years, and we'll come on to the reasons why that is. They had their half-year results out with underlying like-for-like revenue falling by 14% to £1.1 billion in the first half, and that partly reflects the group's shift towards the more flexible fulfillment model, where ASOS only receives a commission on the value of the items sold. Active customer numbers were down 9% to 16.5 million. Underlying cash profits, though, EBITDA, were up 51% to £64 million, and that was driven by gross margin improvements and continued efforts to reduce supply chain costs. Free cash outflows, though, rose by 10% to £93 million due to higher interest costs on its debt. And net debt was up by £19 million to £295 million. Full-year guidance has been reiterated, with underlying cash profit expected to be in the £150 to £180 million range and broadly flat free cash flow. And the shares were largely unchanged on these results. In terms of valuation, they have a market cap of around £260 million and trade at 0.1 forward price to sales compared with a 10-year average of 0.88. And unsurprisingly, they don't pay a dividend. I thought these results were disappointing. I think ultimately it would reaffirm my position that it's uninvestable. It's interesting, both Boohoo and ASOS have shifted towards the fulfillment with third-party products on their websites and delivering them. But when you're seeing the customer numbers fall and the cash outflows increase and that debt of nearly £300 million, it's difficult to see the business continuing like this. Certainly, you can't see any return to growth. I mean, the big thing is that in the last few years, there's been a move for people who are seeking fast fashion to Temu and Shein, and ASOS and Boohoo just aren't able to compete with that. So I just think it's uninvestable, wouldn't be touching it with a barge pole. Sam, what are your thoughts?
Pretty similar. I think the move into sort of more basically providing a platform and the fulfillment center for other companies is interesting, but this isn't like an Amazon or something like that. I think there's a limited number of people going on, and part of the problem is that number is dropping. So how much is that really worth to someone? I would imagine it's quite a limited number of brands that are wanting to sell on there. And when the number of people visiting the website is dropping, I'm just not sure that's going to save the day.
Yeah.
I could be wrong, but I don't feel like they've got this really valuable IP in the ASOS website that can come and save them. So I think maybe it might help a bit, but the general trend still seems to be downwards, albeit at a slower rate now. I mean, we tried it with Boohoo. I just don't have any interest in catching a folding knife, and I think it is very much cheap for a reason. And if it starts re-accelerating, or even if it carries on just dropping kind of 9% a year in terms of customer numbers, it can still fall a long way. So I wouldn't be kind of fooled by the fact that it's already down sort of 95, 98% from the peak or whatever it is. It can go further.
Yeah, and I think the other interesting thing, just on the topic of IP, is that both Boohoo and ASOS did buy up some sort of, I don't know if you'd call them brands, but the high street shops. So things like Top Shops, that's one that ASOS had. And whether it's a brand in itself, potentially, and they were selling some of those sort of products, albeit probably lower quality than they used to be when they were on the high street. I guess you reflect on that and you think with some of those brands that they did buy, they did go under for a reason, and ASOS and Boohoo hoovering them up hasn't really done them any good, basically.
Yeah, I agree.
So, yeah, sad, but I think we both owning Boohoo did learn our lesson. But to be fair, I think
Expensive one.
I know, yeah, very expensive one. But I think the thing that we didn't see is that at the time they were still growing, albeit slower, and the valuations had come down a lot. I think we didn't do what Peter Lynch might, have suggested, which was to go out onto the high street or even ask partners' girlfriends, where are you buying your where are you going for fast fashion? Are you still buying fast fashion? And I think the answer would have been, well, maybe I am, maybe I'm not. But most people I know are going on to Temu and Shein, which would have told us a lot, I think.
But I think as well, it was, although the growth had slowed, it was just after COVID and they'd done really well in that period. So you think, is it just kind of, has growth been pulled forward and then it's going to go back to what it was? Because prior to that, they had a really good track record of growing sort of 25, 50% a year. Whereas now, you're sort of 5 years on, there is clearly a trend of decline now. It wasn't quite obvious in the same way because of that impact from COVID.
Yeah. And, you can give it perhaps the benefit of the doubt for a year or maybe even 18 months. But then I think beyond that, you do have to accept the trends that you're seeing. Yeah. Okay, fine. So how are RELX doing? They've been punished quite a lot, but is that unfair?
So they've come out with a trading update. It's one of the strangest trading updates I've seen, actually. I can't recall the last time I saw a trading update that doesn't have a single number in it, but it is what it is. So RELX, I thought it would be interesting because, like you say, they've taken a bit of a battering with kind of these AI concerns. And RELX, for anyone who's not familiar, we've covered them before. They basically provide kind of professional software to sort of lawyers, accountants, medical professionals. And it's kind of that technical software support. So if you need to go and do sort of very technical research, it's a very, very good resource. Some of the services they provide. So I've used their tax software in the past. It is excellent. So they've come out with a trading update and they've said that they've started the year well across all 4 business areas and have continued to deliver strong underlying revenue and profit growth and strong sales. Our improving long-term growth trajectory continues to be driven by the ongoing shift in business mix towards high-growth analytics and decision tools that deliver enhanced value to our customers. We continue to develop and launch these products by leveraging deep customer understanding to combine our unique content and comprehensive data sets with advanced artificial intelligence technologies. In the outlook, they've said we continue to see positive momentum across the group, and we expect another year of strong underlying growth in revenue and adjusted operating profit, as well as strong growth in the adjusted earnings per share on a constant currency basis. For the risk side of the business, they've said strong underlying revenue growth continues to be driven across segments by our deeply embedded AI-enabled analytics and decision tools. We expect continued strong underlying growth with underlying adjusted operating profit growth exceeding underlying revenue growth. For the scientific, medical and technical division, they've said that improving underlying revenue growth continues to be driven by the evolution of the business mix, very similar. And they've said they also expect strong underlying revenue growth with, again, underlying operating profit exceeding. For the legal side of the business, it's basically the same. And for the exhibition side of the business, they've said strong underlying revenue growth continues to be driven by the improved ongoing profile of our event portfolio and good progress on value-enhancing digital initiatives. Notwithstanding the rescheduling of some events in the Middle East, we continue to expect strong underlying revenue growth with an improvement in adjusted operating margin over the prior full year. That's basically the whole statement. The shares were down 3% following the announcement. I don't know whether that's just because of how the stock markets moved that day, because I don't think there's a huge amount in that statement either way. In terms of valuation, the business trades at a forward PE now of 18.7, and that compares to a 10-year average of 21.5. Prospective yield for the next 12 months is 2.7%, and that compares to a 10-year average of 2.4%. And if we have a look at the share price, that's down 37% over the last year, although it is actually probably up about 20-25% from the low back in what would have been February. I mean, I think this trading statement is a complete waste of everyone's time. I don't really think you can place much weight on it at all without a single number. That being said, the company overall, I think at a PE of 19, it's certainly the cheapest we've seen it in the time we've covered it. I know there's AI concerns. I think this one is probably in the group category where it would make me a bit nervous, just in the same way as when we've discussed Walters Kluwer.
Mm.
Although I think they're pretty solid on probably like the tax and the accounting, and I suspect the legal side as well, because it's a very similar product. My concern would be that medical side. I think there's better options in terms of companies that have been battered by AI out there, one of which we're actually covering on the show later. But I think if I were to do it, it would have to be a basket approach. But yeah, I think it's a good business, but I would probably just want to wait and see, because I just think if you're looking for a high quality sort of techie business that's been battered by AI, there are probably better ones available at similar prices. What do you think, John?
Yeah, no, similarly, to be honest. I was actually just going to ask you, because you do use the products. How much of a moat do you think there is there for RELX?
So on the tax and the accounting and the legal side, I think there's a pretty good moat. So what happens is, in terms of the professional software in the UK market, there's basically two very similar services. So there's one that's owned by RELX, which is LexisNexis, and then there's one called Krona, which is owned, I can't remember who owns that now, but the two are pretty similar. They're both excellent. I've used both. And what I've noticed actually, so I tend to use Krona more just because more firms I've worked at have used Krona, and I'm just more used to it. I think actually where I am now, they don't use LexisNexis, they do just use Krona. What I find really useful for it is with the AI, if I'm asking it questions and stuff at work, I will kind of say, give me a Krona link, because I don't trust the AI on its own, but if it can give me the Krona link to what I'm looking for. One thing I've always struggled with is sometimes, unless you know exactly what you're looking for inside Krona, finding the relevant page is actually quite difficult.
Sure.
So AI, as it stands at the minute, works very well, basically as kind of a search within Krona itself, because it seems to have access to it all.
Interesting.
I don't know how, but it doesn't matter because I've got a login. So what would normally happen is it might pinch it for the answer, and then if you actually try to click the source, you'd need a login, so you wouldn't be able to verify it, whereas I don't have that issue, so I tend to use it just to go to that. If the AI were to get to a point where you didn't need to do that, that could be a problem, but I just think that's such a long way away, because it just lacks that intelligence. It's very difficult to rank one source above another. There's quite a lot of nuances. It's quite difficult, so you could ask it a question that's more on like the personal side, and it could pick something up on the corporation side. And again, it's not obvious unless you have that knowledge to actually judge whether the answer is correct, and you can verify it yourself. And they do basically an identical product for law, so I would imagine that's the same.
Yeah.
So I think AI is a very long way away from disrupting those parts of the business.
Do you think in terms of the customer base that, yes, if you're at, say, and this isn't the accountancy sphere, if you're at a higher quality firm, they are going to be using this product a lot, and they're going to be quite reliant on it, and they're probably going to need a fairly good reason to get to stop. What do you think about in the lower end of the market, where they may have had a subscription to this, but perhaps they wouldn't rely on it as much, and they didn't need to consult with it as much? Do you think that's the kind of end of the market that might be more at risk, and the threat of sort of AI?
I think if there is a risk, it's probably very small firms that probably just weren't paying anyway. Because again, if you've still got like your study materials from when you trained, you've got the HMRC manuals for free. If you're pretty good at navigating the legislation online, in theory, you could get by without it, but it is such a useful resource. And equally, if the AI could get to a point where it could just sort of trawl through HMRC's manuals and the legislation and understand it, it could cut it out in terms of using it for that data. But I just think it's a long way away from that. And I think the firms where they're doing technical work, if you go and interpret a word the wrong way or something, you will get sued.
Yeah.
So I think as a resource, it is really, I would be very, very nervous if I went in on Monday and was told we're getting rid of it and just use the AI. Because I think, I'm going to make more mistakes.
No, that's fair enough.
You're verifying it again. And it's harder to verify against sort of free resources like legislation or manuals, because the problem is, like, for example, like the manuals, they just give you the government's interpretation of the legislation. But that's just some civil servant. It's not gospel. The problem with legislation is it's all legal speak. So sometimes actually understanding what it's getting at is really difficult unless you already know what it says. I'd say for the next 5 years, I don't see it as an issue.
No, it's interesting because, looking at my own portfolio, and thinking about the threat from AI. So I've come to my own conclusion that Rightmove, I think that is safe. I mean, that may be famous last words, but at least safe from AI. I think that does have a moat, and I can't, and with the valuable data that it has, I can't see that changing anytime soon. But the other company, and we have covered it on the show before, is Upwork.
Yeah, that makes me nervous. Yeah.
That I think, I had both Upwork and Fiverr, so people could, advertise for small jobs, and then you could have sort of freelancers kind of competing for those. I think a lot of those jobs were probably digital, fairly small things, possibly things like graphic design, for example. And my worry with that is that as the AI gets better, and even where it is now, that a lot of the jobs that people would have put out for relatively low fees onto one of those platforms, they're probably no longer going to be doing that. Yes, some jobs obviously can't be done by AI and then still do have a role, but if a significant number drop off and the growth, slows. I mean, they weren't as expensive as they were in 2021, but they were still fairly pricey. So I am thinking about that in my own portfolio. So it's really interesting seeing some of these companies that were thought of as very high quality and with big moats, that now those moats aren't quite looking what they were 5 years ago.
Yeah, I think it's just case by case basis, really. But yeah, Upwork.
Yeah,
that concerns me. Should we move on to a business that probably doesn't have much to worry about?
Well, exactly, and this is the interesting thing. So British Land, which is a big REIT in the UK, they had their full year trading statement out last week with like-for-like net rental growth of 6% over the full year, which was helped by a 12% growth in campuses as more AI companies took on the space. So interesting. It's on the back of, to a degree, an AI trend. Estimated rental value rose by 4.9% over the full year, towards the top end of its 3 to 5% annual growth guidance. Occupancy rates from its retail parks and campuses were 99% and 95% respectively. And full year underlying earnings per share growth is expected to rise by 1% to 28.9 pence a share, which was in line with expectations. For 2027, underlying EPS guidance has been upgraded from at least 30.2 pence a share to 30.5 pence a share, and the shares were up around 2% in early trading. In terms of valuation, the group have a market cap of £4 billion and they trade at 0.61 forward price to book, compared with a 10-year average of 0.68, so broadly in line. And they have a prospective dividend yield of 6.2%. I thought this was a decent statement in terms of what the group is doing. So they were badly hit during COVID because, a huge amount at the time was just sort of your typical city centre office space, which with the advent of hybrid working over COVID meant that there was much less demand for that. Prices fell a lot, and obviously the assets on the balance sheet were worth a lot less. It's interesting to see the strategy post-2020. They're pivoting more into the science and technology campuses, like the Optic in Cambridge being a good example of that. Yes, it suits for sort of AI and computing, but also sort of kind of more of that sort of STEM research, which is big growth sector in the UK. The other thing that it's doing is quite a lot of urban logistics. So that's linked with e-commerce and same-day deliveries, which again seems quite a smart move too. And overall, I think the group is in so much better health than it was a few years ago. I think the way that it's being managed now is also, it's adapted well, and it seems to be competent management, basically. I think the valuation is very reasonable, and it's now got a decent dividend as well. That being said, we've got a lot of good REITs in the UK, and there are ones that are yielding more and potentially have more growth ahead of them that I can think of that I probably choose before British Land. But I think British Land, it's now coming back onto the radar as a possible investment in the future. Sam, what are your thoughts?
Yeah, very similar. I think this is probably the most positive statement or set of results I can think of in the time we've covered it. I think they always had a very tough time in kind of COVID. I think the way the portfolio is positioned now, it's looking a lot better. That occupancy, again, probably the best I've seen it. And I think the valuation is pretty reasonable. But yeah, the exact same point as you. I think the issue is there's other REITs I prefer before I get to British Land. But a year, 2, 3 years ago, I wouldn't have even considered it. Whereas now, if I was looking for another one, it probably would be at least worth a discussion.
Yeah, no, I'd agree. Okay, well, onto a very high quality business, but has
Yes.
had a hard time on the market recently.
Yes, so London Stock Exchange Group, it's another Q1 trading update. And it's actually got some numbers in as well. So what they have said, they've reported a 9.8% rise in first quarter organic revenue growth, excluding currency impacts, to 2.5 billion, and that's above 2.4 billion expected. Growth was broad-based across divisions, with markets that stand out, driven by trading activity. Gross profit rose 11.5% to 2.2 billion, and that was in line with expectations. Guidance was tightened, with full-year revenue growth expected at 6.5% to 7.5%, but now skewed towards the upper half of the range. Margins and free cash flow are also expected to improve. London Stock Exchange Group returned 1.1 billion to shareholders through buybacks over the quarter and remains on track to complete its 3 billion programme by February 2027. And for context, that 3 billion programme is on a market cap of 44 billion, so it's pretty decent. And the shares were flat following the announcement. Now, we did cover the last set of results, and management, in terms of the way they were wording it, were making it very, very clear that they view themselves as a beneficiary of AI rather than a victim, despite the way the stock had been treated by the market. And I think really the reasoning was, particularly with the Refinitiv acquisition a few years ago, they've got all this data. And I think it's probably a very similar argument to when we covered Trustpilot a few weeks ago, where actually they're one of the sources that's going to be kind of frequently cited by the AI. So they're not overly concerned, and they view themselves as an enabler of AI adoption rather than a casualty, as that licensed data becomes more valuable and the usage scales. As mentioned, after they bought Refinitiv in 2021, which is a data and analytics business, they now earn most of the revenue from providing tools and services for financial professionals to use daily. And they also generate a lot of revenue from the large markets business, which houses equity and bond trading. In terms of the valuation, it trades at a forward PE of 19.8, and that compares to a 10-year average of 25.2. The prospective yield is 1.8%, and that compares to a 10-year average of 1.4%. I think, if you compare this to RELX, pretty similar valuation, slightly more expensive, but I would feel much more comfortable with London Stock Exchange Group. That being said, it's probably rebounded a lot more off its low. So it's down 20% in the last year. However, you could have got it at about just over £70 a share in February, and it's now back at 90. So it has rebounded, I think, a bit more. But of the two, I think I'd feel pretty comfortable with London Stock Exchange Group. I think similar to what we saw when we covered Trustpilot, I think I probably do kind of agree that their website is exactly the kind of source that AI is going to be frequently citing. So I struggle to see a scenario where they are getting replaced by the AI, because the AI it can't generate data on its own. It's got to get it from somewhere. So yeah, I think this is really positive. I think the organic revenue growth of 9.8%, that, if anything, that's picked up in the last year or so. I think we're used to seeing about sort of 6, 7, 8%. So again, that suggests that these AI concerns probably are overblown. So yeah, I really like it. I don't know if I'd quite pull the trigger on it yet, but it's certainly on the watch list. I think it's a really good company. What about you, John?
Yeah, no, I would agree. And I've become more comfortable the more we think about these different businesses that this is more likely to be a beneficiary of the AI rather than a casualty.
Right. Shall we move on to another business that's unlikely to be a casualty?
Yeah, no, absolutely. So Reckitt Benckiser, it's one that I've owned before. For anyone who doesn't know, it owns brands like Durex, Dettol, Vanish, Nurofen, Strepsils, and it does still have the infant formula business Mead Johnson, but that is in the process of being sold. Anyway, they had a Q1 trading statement out, and Reckitt reported like-for-like net revenue growth of 1.3% to £2.6 billion in the core business over the first quarter. Declines in Europe and North America were more than offset by growth in emerging markets, including double-digit growth in China and India, and excluding seasonal cold and flu products, like-for-like net revenue growth was 3.1%. Including the for-sale Mead Johnson business, Reckitt's like-for-like net revenue grew by 0.6% to £3.2 billion. Full year guidance has been maintained, with a core business expected to deliver like-for-like net revenue growth of between 4 and 5%. Nearly £700 million of the ongoing £1 billion share buyback has been completed, and the shares were down around 6.5% in early trading. In terms of valuation, the group have a market cap of £29 billion and trade at 14.2 times forward earnings, compared with the 10-year average of 17.6, and currently have a dividend yield of 4.8%. I think it's difficult to get excited by these results. However, I think the last few results from, or trading statements from Reckitt have been more positive. I think the turnaround is going broadly in the right direction. And in terms of the Mead Johnson sale, when that's expected to bring in a decent amount of cash, they can look to hopefully continue to focus on the marketing of the core brands, and whether there are any other acquisitions that they might consider, they'll have some money to do that. But that was very expensive when they did acquire it back in the day, and with a slowing birth rate in China, they were pretty badly burnt. However, they do have strong brands. I think 14.2 times forward earnings, hopefully with momentum, as they're talking about in the full year guidance, is going to be picking up. I don't think it's an unreasonable valuation, and it does have that fairly decent dividend yield too. I guess if you're looking at consumer goods companies, then you're inevitably, if you're on the UK market, going to also be looking at Haleon, which was the consumer health division that was spun out of Glaxo, and you've also got your sort of Unilevers up there too, which you would rather have. Bit debatable, but I think it would have to be up there in terms of it's an AI-proof defensive business with a reasonable valuation. And I think if they can get back to decent growth, particularly in those emerging markets, then you could make the argument that it's relatively cheap and you've got decent downside protection and a healthy dividend there. Sam, what are your thoughts?
Mixed. So I think in terms of this set of results, I think they're quite disappointing. I think that like-for-like revenue growth of 1.3% is pretty poor.
Yeah.
But if they're maintaining the guidance for the year of 4 to 5%, they're obviously thinking they're going to catch it up, in which case, fair enough. My concern would be with their track record over the last few years that guidance ends up getting lowered, because if they've already done 1.3% in one quarter, to get up to that 4 to 5%, they probably need to be doing kind of between 4 and 6% in the next quarters. And I'm just not quite a turnaround from where they are at the minute, but you never know. But I'd just be a bit skeptical. In terms of the price, I don't think it's terrible, but I think you do just have a lot of options. Now, that being said, I think Unilever's not the company it looked like it was 6 months ago.
Yeah.
Or I don't think it is. So, but yeah, I just think with the number of options you've got, I probably, based on what I've seen in the last few years, I probably wouldn't be overly interested in Reckitt. I'd rather have sort of what I would consider to be like a higher quality business. I don't know how expensive Nestle is at the moment, but that's probably where I'd be looking first.
Fair enough. Okay, how are ABF and what might soon be just Primark doing?
So, not great. So, ABF, so we've covered them lots of times. Their biggest part of the business is Primark, but they've also got a whole foods business. They've got sort of brands like King's Milk Bread, Patak's Curry Sauce, Jordan's. As well as that, they've got more commodity side. So they've got sugar side of the business. They do stuff kind of like pet food and stuff like that. And loads of stuff basically to do with food. Very, very vertically integrated business on the food side. But lots of random divisions, and Primark doesn't necessarily complement some of those other divisions. So ABF have come out with their first half results, and revenue fell by 2% to 9.5 billion, ignoring exchange rates. However, Primark revenue grew by 2% to 4.7 billion, with growth being driven by new store openings. Grocery revenue was flat, while all other divisions posted declines. Underlying operating profit fell by 18% to 0.7 billion, reflecting declines across all divisions. Free cash flow improved from 27 million to 71 million, helped by inventory reductions at Primark. Net debt rose from 2.8 to 3 billion. And following a previous downgrade to guidance, ABF still expects underlying operating profits to fall below last year's level of 1.7 billion, The outlook for sugar has deteriorated, with the division now expected to post a full-year loss. The interim dividend was unchanged, and they've confirmed their intention to spin out the Primark business by the end of 2027, and the shares fell 4.8% following the announcement of the results. New stores are expected to contribute to around 4 to 5% in annual sales growth for the foreseeable future, with a lot of that coming from America, as we talked about previously. And in terms of valuation, the business trades at a forward PE of 11, and that compares to a 10-year average of 15.9. The prospective yield is 3.4%, and that compares to a 10-year average of 2.4%. I think these results obviously weren't amazing, but a lot of this business is sort of commodity driven and cyclical. I think these results are actually quite a good example of why they're wanting to spin Primark out, because I don't think the shares would have dropped so much if Primark had been a standalone business, because the Primark results were actually okay. It's just the rest of it's dragging it down. I think in terms of that forward PE at 11, I think it's pretty attractive. And I really like it as a business. I don't know what I'd do if I owned it after the spin out. I'd probably want to see how the two businesses kind of got on for 6 to 12 months. I've always liked that it's a bit of a sort of conglomerate, and you've got, when one division's not doing well, you probably have another few that are making up for it. And I've always quite liked that, but I can see how it's going to affect the valuation, because I think Primark is probably, out of the UK retailers we've covered, it's probably in the top 5, but it's always had the other parts of the business dragging it down at times. And I think that probably has impacted the multiple compared to some of the others we look at. So I do actually get this, and I think it probably makes sense. But yeah, I think not the best set of results, but probably not their fault, because a lot of it's commodity driven. But in terms of valuation, I think it's very attractive. What about you, John?
Yeah, no, I think the commodity element of it does distort the results quite a lot. It's interesting in terms of Primark, and if that were to be spun out, because it's a business that, we've been impressed with the growth. It's going over to the US, and the initial signs are that it's doing very well over there. I've been burned, and I think you've been burnt by retail before. I think Next is a very different proposition, and Primark is down there at the lower end. I don't know whether you'd call it fast fashion, probably not. Obviously, it's got its bricks and mortar. Well, it is primarily bricks and mortar, although they do online sort of collections and things. How would you feel about owning just Primark as a pure play, given the industry that it's in?
So I think for me personally, I actually prefer it with the other businesses around it, because you get that protection.
Yeah.
And I feel like it sort of mitigates quite a lot of the risk. I just don't know if I would have the courage to own a standalone retailer again. And I think that's no reflection of Primark, because I think it's a great business. And if I hadn't already been burnt on Boohoo and Debenhams, I'd probably seriously consider it. But, it's probably it's the same reason why I think partly never pulled the trigger on Next. I just don't want the retail exposure. And I think it's a really good business in a very tough industry. And as we've seen, it can change pretty quickly in those industries. So I just think I'd be quite happy to watch. I like following the business. If someone told me they'd invested, I totally get why, but I think it's probably just not for me.
Yeah. Similar, actually. I'd feel more comfortable, and like I had more downside protection owning it as that kind of conglomerate. And I appreciate that at the moment, at least, it's more the commodities and the sugar that's dragging things down. But when times are good, it's just pumping out cash. So yeah. In many ways, the argument might be you buy it now, you own, and whenever it is spun out, you just continue to own both parts of the business, almost as though it were one. But
I guess that's like saying, well, when it's spun out, just buy it and buy another business.
Well, it is, yeah.
That's basically what you're doing.
It is, yeah. But
just going to buy Unilever.
You could just that makes sense too. I don't know. To be honest, I'll probably be sitting on the sidelines.
Yeah, fair enough. So, of the 6 businesses then that we've covered this week, ASOS, RELX, British Land Co, London Stock Exchange, Reckitt, and ABF. Which do you like the most and which do you like the least?
Oh, good question. I would probably have to go for London Stock Exchange Group, top of the list. And last, it is fairly easy. It's ASOS.
Yeah, so I don't really have anything to add to that. I'd be exactly the same.
Okay. Well, thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.